And once we all start speaking the same language, I think it'll be easier to take the ugly face that you've put, or ugly mask that you've put on tax. Take it off. It's not as bad as you think it is.
Not at all.
It's not as bad as you think it is. Faniswa Mavuso joining us. Welcome back. How are you?
I'm excellent, Trusenz. How are you?
I'm good. I'm good. I'm back, and it's good to have you back.
Thank you.
Where were we last time? There were two items that we didn't get to touch on. Time ran away from us.
Yes. So last time we spoke about tax exemption.
Yes.
Remember, you need to declare all of your income.
Yeah.
And some of that would be exempt.
Yeah.
So there's two exemptions that we didn't get to touch on, and that's where we'll start off today.
Okay, let's get into it.
So today we're going to talk about the exemption where you're a South African resident, but you're living and working abroad.
Okay.
Remember, resident means that your home, you call it South Africa.
So the passport that you hold.
Yes.
Okay.
So if you are living and working abroad and you consider yourself a South African resident, you still need to declare all of your income to the South African Revenue Service.
Okay.
Even if you earned it abroad. For example, if you are working in London and you're living in London and you earn a salary from a London-based company, you would still need to declare that income to the South African Revenue Service for it to be taxed in South Africa.
If it's coming back here.
No, so you'd need to declare it, whether you're going to spend it here or not.
Okay.
The fact that it was received by you, a South African resident, means you need to declare.
So they need to know.
They need to know.
Okay.
However, that income is exempt.
Okay.
So because you'll be sitting in a situation whereby your income is being taxed in South Africa and potentially being taxed in London, which is a very unfair position.
So it's exempt because you are paying taxes that side where you are earning.
That's correct.
Okay,
yes.
got you.
But there can be a situation where you're actually sitting with a double non-taxation, which is where it gets interesting. I've actually got a friend of mine who lives and works in Qatar.
They don't have taxes.
They don't have tax laws. So in Qatar, her salary is not being taxed by the government in Qatar because there are no tax laws. And then in South Africa, her income is not being taxed because it's all exempt.
Ha! I need to go work in Qatar.
Very nice. Very nice position to be in.
So in Qatar, like your gross salary is your net salary.
That's it. Very, very nice position.
Well.
Right? I'm actually not quite clued up how the government manages. There must be some kind of nominal amount, because otherwise then how do they run their country? But I'm not too well versed with Qatar law.
I think with them, because they're such an oil-rich nation,
I see.
The government, I guess, keeps a portion of the proceeds of the gross domestic product.
Makes sense.
Yeah.
Makes sense.
And they're like, keep your money.
Yeah.
We'll deal with the...
But there have been developments recently. As of the 1st of March 2020, the South African government has capped that exemption. So only the first 1.25 million is exempt. So 1,250,000.
Yeah.
So if you...
Everything after that is taxable.
That's correct.
Ah.
Yes.
Cyber well, a little 1,250,000.
It's a high threshold, but
tax guys at that level.
It's a high threshold, but clearly there are individuals that are earning that much. Kind of government here to set that
and more than a handful.
Yes,
I mean that threshold is set by some kind of data with statistics. I mean they found a pocket there of,
That is very much correct.
I guess anybody who supersedes that threshold falls into the 1%.
1%.
Oh man, hey.
Yeah.
Nice life problems.
Nice life
1%.
So that's a very, very interesting one. But there are terms and conditions.
Yeah.
In order to qualify for the exemption, you need to have been out of the country for 183 days. That's
in one calendar year.
In one tax year.
Oh, okay.
One tax year. Remember, March to February. So of that 183 days, 60 of those days needs to be consecutive.
Okay.
So the 183 is cumulative. So you can be out of the country, say for 20 days, then come
back and then you go again.
Yes.
Okay.
And then if it all accumulates to 183, but 60 of those must be continuous.
Consecutive, okay.
Yes. So then you would then qualify for that exemption.
All right. Why is that? Because maybe you're paying so many levies and taxes already in your travels and things of that nature.
I think it skews the lines. It blurs the lines in terms of where exactly are you working.
Okay.
Because if you look at 183 days, that's just short of 6 months.
Yeah. So where do you work?
Exactly.
Okay.
Yes.
Okay. Got you.
Yeah.
Got you.
And then to take a look at the other exemption that I wanted to touch on last week is alimony, or rather maintenance.
So that's when the love is gone, the responsibilities are there, the hanging responsibilities.
Yeah.
There is money that needs to exchange.
Yes.
And what are the tax responsibilities when it comes to those monies?
So the tax responsibilities, obviously, if we look at the general definition of tax and how we've been going through it, any income that you earn, you need to declare it.
Right.
So if I get income from my former partner, I would then need to declare it.
Is that considered income?
It is.
Well.
Listen, it's very possible for you to be in that position. You could be dating a cougar, and then when you break up,
when the love is gone. Oh wow! Okay, so alimony and maintenance are considered income.
It's considered income, so you need to declare it. However, it is all fully exempt.
Okay.
Because it's obviously going towards maintenance of
upkeep.
Sort, upkeep of your lifestyle. If you were involved with a cougar and exposed to a very different lifestyle, or the kids who obviously soft life,
Range Rover problems.
No, do not.
Soft life, Range Rover problems,
or in other matters.
200 thread cotton sheet problems.
Egyptian cotton.
My neck. Oh goodness Lord.
Or that maintenance would be going obviously to the kids, who were then part of the love before the love left.
Okay.
That would not be taxable.
But it has to be declared.
It has to be declared, and then you would declare it again under the exemption, so it'll be fully exempt.
Okay.
However, this has also got its own terms and conditions.
Mm-hmm.
So the maintenance received must be by way of judicial order, a settlement, or a written agreement of separation, or by order of divorce.
So it can't just be me sending you money randomly because I know your situation.
That would be considered a donation.
Okay.
Which has its own tax complications altogether. Yes. So say we were in an agreement and we broke it up, and then you need to pay me now 5,000 maintenance. Anything beyond that 5,000 would be considered a donation.
Okay.
And then I'd need to declare that as a donation and get taxed on that.
Okay.
There's
right.
that too.
Right. Because the receiver don't play. The receiver's like, you guys said 5,000, right? Why is there 7.5 here?
Yes.
Have you given anybody a piece of that 2.5? Because I need mine.
The receiver don't play. The receiver's very ruthless. But if you know your way around it.
But fair.
But fair, yes.
Yeah.
Okay. Fair. Because that donations, we'll touch on donations tax. It's a whole other topic altogether.
It's a topic on its own.
A great portion of that would also be exempt.
Okay.
But we'll touch on that at another time. And
like the thresholds and things like that. How much you okay.
Yes,
got it. Where else are we going today?
Today we're going into deductions. Okay. So we've dealt with the income and what part of the income would be exempt.
Yeah.
And now you're sitting with an amount still. And what can you still do to reduce that amount so you pay the least amount of tax possible? So there are a number of deductions. Again, I won't be able to go through all of them. There are so many. I'll just touch on the very common ones.
Yeah.
First one I'll touch on is retirement annuity.
Yeah.
So say you contribute to retirement annuity either via your employer or you took one out on your own.
That matures when I'm 55. Let's say that, okay?
Yes. So the contributions that you make now in your 30s, in your 40s, those are tax deductible now. So what you would do is you declare your income, go through all of your exemptions, and then you can still claim a retirement annuity deduction
Okay.
for all of the contributions. So what you would do on your tax return is you would declare, this is the amount of contributions that I've made. And the nice thing about e-filing is that it auto calculates a lot of things for you.
As long as you follow the format that's there, it should,
So
because the formulas are put in.
the formulas are in there, so you literally just need to put in your contribution
Okay.
amount.
Okay.
But there is a whole calculation, which we can get into if you want.
Well, for the sake of people listening, I think we shouldn't skip anything.
Okay.
Yeah,
cool.
maybe we'll just brush on it a little bit just to give them an idea.
Sure.
Yeah.
So the contributions, the deduction itself is limited to 27.5% of your contribution.
Okay.
So you don't get the full deduction. Or say you donated, or rather you contributed 10,000 towards
Yeah.
a retirement annuity. You won't get that full 10,000 as a deduction.
Okay.
It's limited to 27.5% of your remuneration.
Okay.
So of your salary. And then that is, we spoke about the 1% earlier.
Yeah.
If you look at 27.5% of a
Of
million,
a billion, because we're
That's-
talking about the
that's quite
1%.
that's quite a number.
That's 275 million rand.
Listen, I always tell my sister that yes, I studied accounting, but I had a calculator, so to do the maths in my head.
27. Good Lord, that's a lot of money.
Yeah.
Out
So
of a
there's
billion, which is 1,000 million, right?
Mhm.
It's even worse than I thought. 270. You
Yeah.
Lord.
So there needs to then be a rand value to cap that.
Okay.
And that rand value is 350,000.
Okay.
So you work out to 27.5%, and then it's capped at 350,000.
So they can't take more than.
That's correct.
Okay.
Yeah.
Okay.
So then that would be the retirement annuity deduction. And then to look at something else, say you've got a travel allowance.
Yeah.
Say you have a job where you need to travel for work purposes.
And you claim your your kilometers and stuff.
That's correct.
Okay.
So how your employer would work that into your cost to company is there'd be a portion for travel allowance. So on your payslip or on your IRP5, there'd be your base salary, which is what you get cash.
Yeah.
And there'd be other benefits, one of which may be a travel allowance, and there'd be a rand value to that.
Right.
And then what you can do, so what you're looking at, if we stop just there, is you need to pay tax on all of those amounts.
Yes.
But
Because that's all income.
that's all income.
Yeah.
But the travel allowance portion is not money that you're getting. In fact, it's not a benefit to you because that portion is allocated to you in order for you to be able to travel for your employer.
And you're not traveling for yourself. It's not vacation packages that you're taking. Okay.
So it's not a benefit that comes to you.
Yeah.
You then still incur expenses
Okay.
to travel for your employer. So those expenses, then you can claim a deduction.
Right.
So you can do this in one of two ways. Either you keep a detailed logbook of all of your business travels. So then what you would insert on your income tax return is the actual kilometers.
Okay.
Like the
kilometers traveled.
Yes.
And then there's the rate of whatever per kilometer. So
Yes.
that formula.
that formula.
Okay.
So what you would physically do on your income tax return is it asks you when did you start? So when do you want your start date to be? And your start date can be anything depending on your situation.
Yeah.
So say at the beginning of the tax year on the 1st of March, you were in this job and you had your travel allowance, then your start date would be the beginning of the tax year, the
Okay.
1st of March. It could happen that you only purchased a vehicle on the 20th of August, for example. Then your start date would only be the 20th of August. So in the middle of the tax year.
Right. Because that's when you started claiming
the kilometers,
Okay.
business kilometers. And the same with the end date. The end date would either be the end of the tax year, which is the 28th of February.
or termination of employment.
Correct.
Okay.
So then you put in your dates and then you put in your odometer reading. So you'd need to, if you're in that situation, you need to be very careful to capture your odometer reading on your start dates.
So that you know at the conclusion it should collate with what is in the logbook.
That's correct.
Got it.
And then what the form does, or what you can even do for yourself, is work out then the total kilometers that you've traveled for the year, simply by saying the closing odometer reading minus the opening odometer reading is the total kilometers traveled.
Got it.
And then at this stage, you would then take out your logbook and tally up all of your business trips. Say you traveled from here to Mthatha, you work out how many kilometers that was. You traveled from here to Cape Town, you work out how many kilometers that is. And you've got a total amount for your business travel for the year. And then you slot that into the form. The formula is quite complex for us to get into, but it's all auto-calculated on the form.
Okay.
It would then calculate based on the kilometers you've inserted, the rand value that would then go against the travel allowance that you've declared at the beginning of the form.
And all of the elements of this logbook are pre-taxed, right? Like your fuel and all of that. Those are taxed as you buy them. So
we'll get into the fuel. So remember I said there's two ways in which you can calculate the travel claim. So it's either you keep a detailed logbook or you keep detailed receipts. Yes.
Got it.
So if you don't have a logbook, then you would need to keep receipts every time you put in petrol for a business trip. You'd keep that receipt. Every time you repair a part for business travel, you'd keep that receipt, etc., which is quite a thing to do, because how then do you separate this repair I'm doing is so that I can perform the business trip?
Yeah.
Or is it just to go down to, what are the clubs here?
To Buccaneers or wherever.
Right.
Got it.
Yeah.
I think let's keep it there for now.
Okay.
4 minutes before 12 o'clock. Her name is Faniswa Mavuso from the Tax Cafe. She is our resident tax specialist. And should you have any questions, you can get her on
Facebook, Twitter, all of the social media platforms, the Tax Cafe. I've actually started something very interesting on YouTube.
Okay.
I call it the Coffee Minute.
Nice.
So it's basically like really short clips, 10 minutes, 8 minutes, where I delve into some of the topics that we spoke
and you just unpack them nicely.
And unpack them. My latest video, I actually went through a tax return, and I had one up and I pointed everyone in the right direction.
Nice.
Where to go when you're filing your tax return.
That's her from the Tax Cafe. Check her out, and we'll see her again next week, Wednesday. Thank you so much.
Thank you so much.
Listen, you could have been anywhere between 9 and 12, but this is where you chose to be. For that, we are eternally grateful. However, all good things must come to an end. Piwe, Amanda Piwe Gatsiba, standing by, of course, with the invasion coming up. From my side, until tomorrow, you guys take care of yourselves so that you can take care of each other. Peace.
We are extraterrestrial. We are KNR.